We have our panel session on capitalizing on megatrends in public markets. Here joining us today, we have Chen from Tribeca Investment, Paul Rayson from Hearts and Minds, Chen from RC Global Funds, and Dagan from Peak Asset Management.
Are we on? So we don't have a moderator. We have to make up our own questions, which will make it even easier for us to
we can talk for ages
to answer them. All right. Well, I'll start. I suppose we'll introduce ourselves first. I'm Paul Rayson, the CEO of Hearts and Minds Investments, which is a listed investment company. We invest in global equities. We have a concentrated fund. The unusual part about Hearts and Minds is we all do it on a pro bono basis, and therefore, in the absence of any investment fees, we're able to donate up to $15 million a year into medical research. So it's a little bit of an unusual company that has a commercial purpose, but also a social purpose as well. And the only other relevant bit of background for this particular topic is before that I ran ComSec for a number of years, so I've got some understanding of investment markets. But I'll pass to you, Chen, to introduce yourself.
Sure. Thank you, Paul. Chen Liu. I work for Tribeca Investment Partners. I run the Tribeca Alpha Plus Fund, which is a long-short fund, just over $1 billion. And actually been participant of the Hearts and Minds, and I've got to know the wholesale investors for the last 5 years, I think. And it's been an incredible honor to be here with my panelists and talk about the megatrends.
Roy, do you want to introduce yourself?
Sure. I think it's already on it. Yeah, I'm just doing a small PR for our company. Chen, I'm the founder and portfolio manager for our small little outfit of running global shares. We currently run our flagship fund, which is investing in global energy and infrastructure related equities. And we spent a number of years building up the track record. So we have maintained a very low profile. Hopefully from now on, we'll start to raise our profile because we think we can offer some interesting kind of diversification for a lot of other investors.
And Niv?
And Niv Dagan, Executive Director of Peak Asset Management. We're a boutique investment management corporate advisory business. Done a lot of things over the years with Steve and Chen and Paul. Our model is all about co-investing. We look at IPOs, predominantly placements, small caps. And in everything that we do, we have to co-invest and back it with our own capital. And then we help the companies beyond capital. So whether it's networking or joint venture partnerships or updating a pitch decks or introducing through our networks, but anything that we can add value, that's our key. So it's great to be here.
Okay, in the absence of questions, I'll just start talking and introduce the topic, I suppose. Megatrends. What do I know about megatrends? Megatrends are obviously, long-term trends that, over the long term will transform whole industries or in fact, create new industries. And I suppose in the sphere of public markets, they're best represented by thematic ETFs. In Australia here, you've probably got 15 to 20 thematic ETFs, and in the US there's hundreds that represent, not only the major 15 or so global macro trends, but also, subsectors and niches that you can invest in to get exposure to megatrends. But the point is, I think, they're long term and they will emerge over the course of many market cycles. So the market downturn we're experiencing right now, I think you'll find if you look at the prices of many of those ETFs, both locally here and in the US, many of them are down, 30 to 50%. Some of the niche ones are down 60, 70%. So now might be a good entry point to start to get some exposure to megatrends. But I think the important thing is that they are long term. There'll be long periods of time where they underperform markets. I did take time to look at the largest ETFs in the US, and the top 15 thematic ETFs of all, but bar one, have all underperformed the NASDAQ over the last 5 years. So it's a long journey. So it doesn't mean they're poor investments, it just means it's a long exposure. So thematic ETFs are obviously one way to do it. I'll pause there and come back on other ways to do it, but I'll pass to Chen now.
Yeah, I think it's a really interesting point, like megatrends in the public market. one of the amazing things about public market, clearly I'm a fund manager investing in the share market, I think it's just incredible opportunity and liquidity for you to gain access to those mega trends. Thematic investing is possible. Well, it actually does very well across the share market, just simply because it's very liquid. You've got your ETF, you've got your shares that give you access to those markets. And another incredible thing about the trying to capitalize on the mega trend in the public market is that with the market volatility, share market worry about different things from time to time. They worry about recession, they worry about interest rate, worry about inflation. That creates significant amount of volatility in prices. So, for a long-term thematic investor, it's absolutely give you opportunity, the access to those companies that will, play into a lot of those themes. And to me, that is just a fabulous opportunity, because private market, you just have no access to it. It's incredibly difficult. And I guess another thing with with the mega trend in the public market at this point is that we have a number of theme that's playing through our market in the last few years. One big one is this electric vehicle. In fact, we were talking about it, before the session. We were talking about, is Tesla going to be a different company? Tesla going to be bigger than GM, or that sort of conversation in 5 years. It is a mega trend, and we can play that through the public markets. In Australia, it's a little bit limited, but in Australia, we kind of play it through the resources side of things. The component, the EV components, whether it's copper, whether it's nickel, or whether it's lithium, cobalt, and a few other commodity that's really highly required for the battery usage, which we know battery is a big cost, goes into the electric vehicle. So, these are the themes are playing out, and then with increasing demand for these sort of vehicle, over the next many years, we were looking at the demand trajectory is incredible. We just can't keep up. Just means, demand for a lot of those commodity will be quite high. And so that's how how the opportunity exists, in the share market. And then, as the share market investor from time to time become disillusioned because there might be recession at foot, this is the time when you can actually pick up those opportunities that is presenting. So, that's how I see it at this point.
Now, Niv, you're an expert in base and battery metals, so what would you like to say?
Don't know if an expert, but now look, I agree. I think ETFs are a great way to gain exposure to a basket of assets at a time. Having said that, there are some restrictions in terms of liquidity, in terms of the net asset values that might be trading at below par. So sometimes, we believe that investors can also get direct exposure through the stock market. I mean, if you compare that to, call it property, that's the beauty about it, having, got liquidity and low base of entry and a low cost of entry as well. Going back to some of the things that we're seeing, absolutely. Look, we had Goldman Sachs JBWE just come out only 2 months ago saying that the lithium bull market is over. And there's a huge supply-demand imbalance right now, and we strongly disagree with that. We're seeing the electrification of vehicles continuing. There's this huge demand. Just today, and looking at what BMW is saying, that they're moving actually away because of the electricity costs are rising. They're moving actually to green hydrogen, and that's going to be a key driver for us to fueling their infrastructure. The problem with a lot of these companies is just is really the infrastructure spending and the cost, and things are still not viable. And last panel I was over here actually was at a renewable panel, and I was just having a chat to Rachel just before, who runs the Australian Shareholder Association. She's here, and we're just having a bit of a chat. And look, what we're saying overall is that there's a really, really big gap between still renewable energy, their cost, their usage, to traditional such as fossil fuels. And that's why you've seen the price of coal and the price of oil and gas drive up significantly. It is going to take some time, but we are seeing still green energy, green hydrogen, the EV revolution are still key themes that we still like, and we're still buying at these levels. And there's a huge disparity. If you're looking at, for example, the uranium ETF or the green hydrogen ETF, or even the price of lithium carbonate, the stock prices have fallen by about 20 to 30% relative to some of these ETFs. There's a big gap, and we've been using that gap essentially to add specific stocks that we see some value in.
And Roy, what trends are you watching?
Well, as my 3 previous panelists have highlighted very well about Megatrend being picking something long term. And so, in a sense, what we do is we are not that different from ETF, except we are actively managing a number of these mega trends. So I'm just going to highlight two of them. And this goes back all the way from the time I graduated. One of my classmates wrote about energy. And this is about, we're talking about decades ago. So I remember that always, that energy is something that is going to be needed all the way through human society. The only thing that changed over the years is the mix of different energy. I mean, years ago, you wouldn't heard so much about renewable, but now it's everywhere. It's a buzzword, and it's serious because of climate change. So the two areas that we are most focused on, one is on, within the energy, oil and gas side, LNG. And you just think about LNG, Australia, obviously, the company most involved in that is Woodside Energy, now previously called Woodside Petroleum. So if you look at liquefied natural gas, it's actually growing faster than gas itself. And every day, people tend to focus on the ups and downs of oil price. But the more interesting thing is actually looking at gas. I mean, just think of during the height of the pandemic, LNG was trading at $2 per million BTU. Now, partly because of the crisis in Ukraine and the war, and also the energy crunch that Europe facing last winter, low storage level, now we're talking about $40 per million BTU, from $2 to $40. And yesterday, I was actually attending two other conferences, one from energy consultant, Wood Mackenzie, and another global infrastructure, both talking about LNG. It is unlikely to be anything back to those $2, $10 for the next 3 or 4 years, because it takes a lot of time to discover the big resource of gas, to develop, build the plant, liquefaction, the regasification, all the infrastructure needed. I mean, the whole of last year, despite all this demand, there was only 2 projects that have gone to FID. So just think of the demand, and then now Germany tried to win itself Russian gas dependence. So obviously there are some big winners, and the biggest winners of all in this area is actually the US, because the other one that's been busy building liquefaction plant. They signed a lot of contract with China. Under Donald Trump, they forced China to buy more US goods, and one of which was LNG. And now China is laughing because China bought a lot of LNG last year, relative to today's term, low price. Now they're even re-exporting some of the LNG to Europe at high price. So LNG is one, and the other one, and is, you can build a pipeline in Russia, got plenty of pipeline to Europe. You can pipeline over land, but to get that energy, like liquefied natural gas to Japan or from Qatar to Europe, from US to whatever, how to get that energy across, you need the LNG vessel. So shipping is another area that we're very bullish. I mean, during the pandemic, we switched our focus from shipping of people, which is airport, airline, to shipping of goods because of e-commerce. So we went into UPS, FedEx, Deutsche Post, DHL, and now then came container shipping. Just look at the freight rate from Shanghai to US West Coast, again, gone through the roof. Now we're starting to see a little bit of slowdown in look at Walmart result, and some slowdown in the mix of what consumers are buying because of high energy price, high food prices. So you need the vessel, and the world is short of vessel. So LNG, shipping, and food.
I still remember when oil price went negative briefly. During that pandemic, I woke up middle of the night looking at the Bloomberg. I was thinking, is that possible? Remember, it was for a day or two. It was an incredible experience to see that. I absolutely agree. I think energy is, it's very interesting, and it's certainly a trend. During that energy transition, you'll see a lot of shortage and demand for product and things around the pipeline or, alternative energy. Like when I think about, when we run our portfolio, we always look at the short term and then the structural and then the strategic. our society is forever changed post the pandemic. The digitization, to me, has really just reached a new level. For the short term, yes, we're short energy, we're short a lot of those things, but eventually we're going to work it through. You're seeing the oil prices now becoming a little bit more volatile because the potential for recession and everywhere else. These are the things you can capitalize for the short term. For the next couple of years, yes, you can make a lot of cash out of those businesses, those old school energy businesses, because no one is investing more in those assets, and they have remaining residual value that is probably more than what their share price is indicating at the moment. However, when you run a portfolio, you want to have something that will future-proof your portfolio. You don't want them to disappear after 2 years. Then you kind of go, what's beyond that? You want it to grow, generate that return, and to me, these are this digitization is a huge thing. I don't know, when the pandemic first hit, when we had to sit at home, we didn't think it was possible we can actually live and work and do everything so seamless like it is now. We didn't think it was going to happen, but it did. There was quite a huge amount of investment into those space, whether it's Zoom, or everything else, to make that infrastructure available. And now it is. And then now we also have the culture to be able to work anywhere and everywhere. So that is something that is here to stay. And we need to realize those sectors that supply to that whole supply chain, in the short term, they might get impacted. Zoom share price is tanked. And yes, absolutely. In the short term, or Netflix, share price hasn't done very well more recently because the interest rates gone up, or the valuation comes out of it. But when you take a longer term view, these are the businesses will remain with us forever. Netflix, for a period, it became the biggest media company. It is out there investing in the biggest media deal, making all the movies. All the Netflix originals are on the top charts. All the actors, actresses want to work for it. Making programs and producing for Netflix. They will be the biggest content holders. Their business model may evolve over time, clearly, because the subscription model isn't going to be sustainable, and be other things evolved. But these are the businesses that will become very dominant in our lives. And what the current public market is probably not reflective of its true long-term valuation. And these are the times where, as an equity investor, you just see a lot of opportunities of picking up things that in 5 years will be a whole lot larger, and that will future-proof your portfolio, while at the same time you may want to take advantage of the shorter term, your commodity boom and all of that, to construct the portfolio together.
You're right, it is a mix of short-term and long-term, and I think base and battery metals are a good example of that, where many of the share prices at the moment are factoring the impact of a recession on their volume. So their share prices are quite depressed, but I think they will benefit from the gradual unlocking of supply constraint disruption, so there will be some price upside, and many of them are exposed to the longer-term trends of electrification and decarbonisation. So you've got the beauty of a relatively reasonable price now, upside from the ongoing turmoil we're in terms of supply side constraints, but the longer term exposure to EVs and decarbonisation. So that is a sweet spot right now, I think. Just rounding out the exposure on public markets. So as I said, thematic ETFs are one way to do it. I looked at the 5-year numbers of the largest ETFs. All of them bar one, which was global clean energy, underperformed the Nasdaq. Clean energy outperformed, which was interesting itself. So it is a very bumpy ride, I think, with thematic ETFs. You can try and pick winners in certain trends, and I know we've talked about energy and a few other things, but we've got genomics, we've got artificial intelligence, we've got big data, we've got personal healthcare. There's no shortage of these trends. Picking individual winners, though, is very hard. Finding the next Amazon in e-commerce or Apple in devices is very difficult to do. So that's a very difficult thing to do, and I probably wouldn't recommend that as a way to get exposure, other than choosing to invest in leaders that are already in well-established trends, like the mega cap IT companies and the next tier, where those trends still have a long way to run, and you've got obviously well-established leaders. And the third way to get exposure is through an active fund manager, like June Bay.
I was going to remind you, you do have a fund manager sitting there.
And I having looked at the performance figures of ETFs, I would probably recommend an active fund manager. Very hard to get pure exposure to a particular trend, but there are a few here in Australia, and there's certainly a few in the US, particularly the broader decarbonisation trend. And at least with an active fund manager, you've got someone really monitoring developments in the market, because the market dynamics are quite volatile. There's regulation, there's changes in competitive intensity, there'll be a handful of winners and a number of losers. So if you've got an active fund manager watching, risk weighting their exposure, whereas an ETF is purely market weighted, that's probably a sensible way to play a longer term trend. But the important thing is this shouldn't be your core portfolio. From my days in ComSec, I saw many new investors, their whole portfolio was in their 3 favourite thematics, which is really risky. It's a risky way. You really need a core holding of a broad index or a number of more mature companies, and play as satellites your 3 or 4 favourite thematics. Don't put all your eggs in 3 thematics. That's one thing I can give you. Steve.
Question. How do you see generational trends impacting megatrends as far as a shift from the wealth transfer from baby boomers to millennials and so forth, and also the peak sort of earning capacity of millennials, and also the rise of Gen Z as well?
Who wants to answer that one?
I don't mind saying a few words. Well, I mean, the younger generation, they demand certain things that we may have overlooked, people like myself. They want a better environment to live in. So that's why things like climate change become important. And that's where renewable energy become important. So I mean, even though we like oil and gas investment because those companies provide us a lot of free cash flow, the dividend and all that, but for the future generation, to go to a cleaner environment, you need a lot more clean energy. So for example, June mentioned about digitization. I mean, we also invest in things that tie to digital infrastructure. Think of electric vehicle. Electric vehicle need a lot more chips than traditional internal combustion engine vehicle. And we're now having a chip shortage. So there's another trend that you cannot overlook. But to me, I'd like to see my children, my grandchildren live in a cleaner world, a healthy world, and a more peaceful world. So those are trends that we can embrace and try to make the best out of it.
I think absolutely young people are very socially conscious, very socially and ESG focused, very, very much so. They've been brought up in a world that is so, there was so much discussion about electrification and everything. So when they invest their dollar for investment, they always invest with the things they believe will make a difference. So this is one, all the research has done. So, they will absolutely be the future investor to drive a lot of those trends. As talked about before, they also grew up in the digital world. They will use things very differently from we do. My kids started playing Roblox when they're very little, and we spend I don't know how much money in buying those little gift cards. It's coming to you. So, and these are the new rise in those businesses that as older investor, we thought, how can they even have a business? But, it's incredible. It's, they got hundreds of millions of clicks every month or active players every month. And then they just have money pouring in because those gift cards they sell to use on those platforms. These are the rise of the digital community in the future. And we, at this point, we just can't fathom. But we need to watch those trends. And these are the kids that will, when they grow up, they will invest in those things. And they will be the one probably invest in the cryptocurrency and all of that, because a lot of those game coins can be used within those platforms. And the rise of the gaming and digital gaming has been huge relative to, the advertising dollar that's being spent on the normal traditional media, multiple times larger. So that's the trend that is going to dominate, the future investing.
I just want to add to a few points. So the SEC, which is a regulatory body in the US, has just made it mandatory for large organisations to report the ethical, sustainable footprint. So technology is very, very interesting in terms of how do large organisations actually report the ESG in the annual report, right? I think that's a big mega trend. Another is food security, as you mentioned. I mean, the generation these days are a lot more conscious about the environment. They are a lot more conscious about clean energy and the electric vehicle revolution. So that's also. The key, though, is finding, I mean, ETFs, and this is probably the advantage of ETFs, I know we're talking about ETFs, is that you don't necessarily have to choose specific management teams indirectly to drive the organisation. The key to how to identify stock picks is backing the right teams and the right people behind it. So good CEOs with a track record of execution and delivering shareholder value, skin in the game. I know I regularly talk about that, but how much has a CEO or the management team paid for their shares? Have they received freebies? What's the team like? I mean, the CEO might be a great salesperson, but the best way we find, for example, when we're doing a site visit, is actually speak to the account managers, to actually speak to the people on the ground that are actually building, and just to get some feedback and see what the culture of the business is like, right? So I think backing the right people and the right management team is critical, but also deep diving in terms of who's behind it, where things are at, and what motivates them is also important.
I think doing your home, the broader idea of doing your homework is really important. Take the EV ETF, for example. If you look at the composition of that, you've got mining companies, you've got new car manufacturers like Tesla, you've got a whole lot of old traditional manufacturers, you've got retailers, you've got semiconductor companies. But it's not, the earnings of that ETF parcel, if you like, is probably going to be more driven by traditional earnings than it is by exposure to the new megatrend. And you've also got to think over the long term, where is value going to accrue? Is value going to accrue to the resource companies or the manufacturer, or is it probably more likely going to accrue to the IP and the soft assets that are in that exposure? So doing your homework as to which part of the value chain of a megatrend is pretty important. But again, that comes back to doing your own research or choosing an active fund manager who can do that work for you. We have time for questions. Can we take questions from the floor? Steve and I have got a bet between the relative value of General Motors and Tesla, and every 6 months we measure the value. At the moment, Tesla's up 35% versus GM down 15%, but I'm still confident that the old guys will make a comeback.
Look, if it's a 6 month, I'd be going with Steve, not you. If it's 5 years, might be a bit different.
My question, so the other part to megatrends is also adoption curves. I know you're obviously very sort of long short as far as how you approach things. So how do you assess where a new technology or a new how do you assess where a new technology is in their adoption curve? And how, I suppose, how do you looking at it from a trend perspective? So I know typically, so you mentioned about crypto before, typically people that follow crypto try and understand where the developers are going and where the engineers are going to look for trends. I suppose, where is that adoption in the sense of EV adoption? Where is it in renewable energy adoption? What are the cost impact? Like as far as renewable energy as an example, solar energy is now cheaper than it's now the cheapest form of electricity ever. So if you're thinking about like how are you assessing where it is in the adoption curve? Because obviously there's a point in adoption curves where the value gets compounded from the investor side. So I'd love to get your perspective on that.
Look, energy is interesting. I 100% agree with what Roy's saying as well, just in terms of the LNG footprint and the supply-demand imbalance and the fact that transportation and shipping, etc., is a big issue. Uranium is something that we haven't talked about. So we're actually listing a uranium IPO. It's a company called T92 Uranium. We've got a great board and a great management team. And look, uranium on a footprint actually as per energy usage is going to be one of the cheapest and cleanest in the world, and that goes beyond solar, and that goes beyond wind, and that goes beyond green hydrogen. So look, we like uranium. Obviously, once again, backing the right team. It is early. Regulatory is potentially an issue, but we are seeing globally a big shift away from, call it China, Kazakhstan, Russia, in terms of energy usage, and we think uranium is very, very interesting.
I'd like to say something about, in terms of future trend in energy, is one, currently it's not economic, but you hear a lot, especially my ex-boss, Andrew Forrest, talk about this thing all the time, hydrogen. Might have to give another 10 years or more, but that will be one source of clean energy that can replace natural gas one day. It could be, as I said, 10, 15 years away, but because there are other things that electric vehicle can't do. I mean, you want to fly an aeroplane, you can't put all that tons of battery into the aeroplane and fly the aeroplane. That's why today jet fuel is still needed. But if you look at the future, the only thing that can possibly replace jet fuel will be hydrogen. So it's just a matter of time.
I suppose that goes back to the adoption curve perspective, right? Because if you look at all new innovative technologies, there is even just the simple car. Like it's when it went from horses and carts through to cars, there was a period of sort of 10 to 15 years where that transformation happened. And the adoption, like if you look at the traditional sort of S adoption curve, like what does that look like for hydrogen? Where would you, is it at the early adopter phase? Like what phase is that, would you describe that as being at?
Well, currently, there's alternative other than green hydrogen, blue hydrogen, gray hydrogen. Even shipping hydrogen is a bit of a problem. So people are talking about shipping ammonia and then convert ammonia back to hydrogen at the receiving end. So there's a lot of technology involved in this area, and I can only say that this is a space worth watching.
I think the point is that, as you know, they're long-term trends, so you're going to have lots of ups and downs. You need to be very patient, and you can have drawdowns along the way, so you just need to be very patient, and it needs to be a part of your portfolio, not the entire core of your portfolio. We're out of time. Any last comments, Junbei?
Look, I just thought, in terms of the megatrend, it's, we're seeing incredible, many of them playing through the public markets. And just like what Paul was saying there, make sure you run a diversified portfolio, don't pour your eggs in one basket. And then because that journey is going to be bumpy, no journey is ever smooth. We talk about which one reaches the adoption, the tipping point of the adoption phase. You can say electric vehicle and the like, and because it's now generally accepted, you want to have an electric vehicle at some point in the next 5 years. Everyone think that way. So, however, along the way there will be bumps and journey. We may have a recession, might become a bit too expensive. Maybe lithium price is too high. The car price can't be lowered enough. And then these will pass, will work its way out over the next few years. And but the longer term trend is here to stay, and we can all see it. That's what makes investing in the mega trend actually in a way easy. But just make sure you size them properly, and and you can wait out the difficult times.
Just last words. I mean, 100% agree with the panel. Diversification is really important, and backing the right team and the right management team is critical. So, just want to say thank you.
All right, we might call it a wrap there and make way for the next session. So thank you.